Hello Premium Hunters, it's time for another episode of my weekly portfolio performance update. This is for week 8, February 17th through 21. My name is Andrew and I'm here to bring you better options. I have been trading options for over 25 years and I'm consistently averaging well over $5,000 per week with my options trading. And this is where I pull back the curtain to show you exactly what I do and exactly how I do it. I post these update videos once a week, typically on Mondays, so that if you're interested in options trading and you want to follow me on my journey, be sure to like, subscribe, and hit that notification bell. Now, a quick disclaimer before we get started. I am not a licensed financial advisor, and the information that's being provided on this YouTube channel is for informational purposes only. Highly recommend that you consult with a licensed financial advisor before making any financial decisions. With that said, if you are brand new to options trading, I would highly recommend that you check out the Demystifying Options video, which is linked in the comment section below, and it will give you some basic fundamental concepts of what I'm about to discuss in this video. It will just be helpful for you to understand and follow what I'm talking about. All right, with that said, let's go ahead and talk about what to expect in today's video. So what I typically cover in these videos are the closed trades. I'll talk about the strategy that I used for the trade. I'll talk about the goal for the strategy, how much I profited or how much I lost if I lost money, and an overall analysis of that performance. And then I'll look at my overall performance for the week. We'll tally up my weekly trades to see how we did in total for the week, and we'll compare that to previous weeks. How did I do? Was it better, worse, about average? And then any insights I get from this analysis, I'll cover that and go over that with you guys. All right, so before we get into this week's update, let's look at how I did for previous weeks. This is a table that I maintain for the performance for each week, and you can see how I've done so far, weeks 1 through 7. My best week so far is week 5, where I made $10,738. And then you can also see at the end of the 52 weeks, you can see my total for the year so far, which is $40,632 with an average of $5,805. So week 8, how did I do? Stick around and find out. So my closed trades, I had a total of 11 for this week. 10 of them were profitable for a 91% win rate, while only one was a loser. So how much did I lose on that one? Well, we'll take a look and find out. All right, so the first trade that I have here, my first closing trade, this is on ES, and that is the SPY futures. This is a strangle. I trade strangles on the SPY futures. I typically have 2 strangles open at any given time. And this particular strangle that I closed out last week, I made a profit of $1,558. Basically what happens on a strangle is I sell a call, and then I also sell a put. And as long as the underlying, which is the SPY, stays between the call and the put prior to expiration, I'm going to make money. But typically I do put in a good to cancel order for 50%. So even though these are longer term trades, they're not open for the entire time frame. They're typically open for about 2 to 3 weeks. And this one that I opened on January 27th, I just closed last week on the 19th. And then as you can see, I have 2 more that are open, one that I opened on the 13th and another one I opened on the 19th. All right, so let's look at the next one, which is Baidu. Baidu is a trade that I put on, I think I opened it, well actually you can see that I bought the shares on November 11th. And the reason I bought those shares was because it was a trade that went against me. And so when the trade closed out, I ended up buying shares. And so in order to bring that trade back to a profitable position, what I'm doing is selling calls on the shares that I own. And I just closed out my recent calls that I closed at a 95 put. The CC stands for covered calls. I closed that out for not a lot of money, but it was $69 and it looks like 49 cents. and then I immediately opened another one, and as long as the stock stays below the purchase price of my shares, which was $108, then I'm going to keep selling these calls as long as it doesn't go too far below, so that I am able to collect some premium and generate some income from them. But you can see currently my cost basis on the shares that I own is $86.24, and the stock's currently trading right around $95, 94, 90. Yeah, it's bouncing around between $90 and $100. So I'm still well above my cost basis, and I'm able to collect some premium. So I will continue to do that. It's just extra income that I'm collecting while I own these shares. So my next trade is on Google, and Google is a stock that I'm using the weekly wheel to generate weekly income from. I'm basically printing money using the weekly wheel. And if you'd like to learn more about how to print your own money using the weekly wheel, then definitely check out the video that I released last week, going through a step-by-step process of how to trade that strategy. But let me go ahead and show you how I've been trading it on Google. So as you can see here, I own 600 shares of Google at $187.50. My cost basis on that is $171.92. I bought those shares on February 14th back here. That's because this put that I sold on Google with a strike price of $187.50 went in the money, and it stayed there until expiration. So if you sell a put and it goes in the money, you're going to have to buy those shares at the strike price that you sold, which is what happened to me here, which is perfectly fine. I've been selling puts on Google for quite some time, and I've been collecting premium on those puts that I've been selling for a while, which is why my cost basis is down at $171.92. So now that I own the shares, what I can do is do basically the same thing, but instead of selling puts, I'll sell calls against the shares that I owned. And that's what I did here. I sold a call with a $185 strike price that stayed out of the money at expiration and enabled me to collect $322.43. And I will be selling another call today. And if my call stays out of the money, I'll collect the premium. But if the call goes in the money, then I'll end up having to sell the calls at the strike price that I sold. But then I can just turn around and start selling puts again. And I'm just basically printing money all this time. Now I do have some other trades on here, and that's because I'm actually also using Google. I want to own some shares of Google. I sold some Tesla stock at a pretty nice profit because I've held them for quite some time, and I want to transition that money into Google. So I'm selling cash secured puts, and what happens with the cash secured puts is I get to collect premium while I'm waiting for the price to come back down. It enables me to buy stock at a discount. And if you would like to learn more about how you can buy stock at a discount using puts, then I recommend that you check out that video linked in the comments below, which will give you more information about how that works. But the first cash secured put I sold here was at a $182.50 strike price. It stayed out of the money, and I was able to collect $740.61. I then sold another cash secured put here with a strike of $180. And as of right now, it is in the money, so I might end up having to buy the stock. But the nice thing about it is, had I bought the stock when I decided I wanted to buy the stock, I would have paid a higher price for it, and I would not have been collecting premium. But I decided to sell the puts instead, collect the premium, and if the stock price comes down, causing my puts to go in the money, then I'll end up buying at a lower price and collecting the premium on top of that. It's a win-win situation. All right, so let's move on to the next one, which is Palantir. I know this looks a little messy here. There's a lot going on, but just stick with me here and I'll explain what's happening. So the reason there's so much going on here is because Palantir is the other stock. I selected two stocks to transfer some of that Tesla money into once I sold my Tesla shares. One was Google, and then the other one was Palantir. So Palantir is a stock that I'm running the weekly wheel on to generate and print money. And when you run the Wheel of Fortune, you do a lot of trading on a stock and you eventually get a feel for that stock. And because it's showing a promising future with the fundamentals that it's posting and the earnings that it's posting, I decided that, yeah, let's go ahead and buy some Palantir stock. So I'm continuing to run the weekly wheel as well as selling some cash secured puts to buy some shares. And so let's walk through those. You can see here that I sold some puts at a $117 strike price. There were some of those puts were designated for the weekly wheel, and some of those puts were designated for cash secured puts in order to buy some Palantir stock. And I closed the weekly wheel at a $506.20 profit, and the cash secured puts that I sold in order to own Palantir ended up generating a profit of $3,264.72. And then, of course, once that closed, I went ahead and sold some more puts. Same basic thing, but this was at a $123 strike price. And as you can see here, Palantir decided it wanted to go back to being a volatile stock, which it can tend to be. And that's you do have to be careful with some of these more volatile stocks. That's kind of the trade-off. Some of these stocks that have a very promising future also tend to be a little skittish, and they can tend to be volatile. So there's always a trade-off. Now, even though the stock did go in the money, I do get to keep all of the premium that I collected when I sold these puts. So the weekly wheel ended up generating a profit of $738, and the cash secured puts ended up generating a profit of $4,920. So I now own 2,000 shares at $123 per share. They were purchased on 12/21/25, and they have a cost basis of $118.90. That is for the cash secured puts. I also own another 300 shares for the weekly wheel that I will be selling calls against, and you'll see those in next week's performance update. All right, so the next stock is a stock that I also trade the weekly wheel on. Interestingly, I decided to run a little experiment this time. I wanted to do both a weekly wheel selling a put and at the same time doing a put credit spread just to see what my return would be on each one of those. And of course, wouldn't you know it, at the time that I do that, Amazon, which has been trading pretty much in a trend sideways for quite some time, decides that it's going to sell off and put me in a loss position on the put credit spread. And that is the losing transaction that I had for this week. So let me go ahead and explain what's going on here. Back on the 10th is when I decided to sell both the put and the put credit spread. A put credit spread is where I sell a put that's closer to at the money and buy a put that's further out of the money. And this shows you the break even, which is right here. I can make a profit. The stock can go up, it can go sideways, or it can go down, and if it does go down, I'll make a profit here. The advantage to a put credit spread over a put is that it is a defined risk strategy, meaning that you are limited to the amount of money that you can actually lose if the stock does go against you. And that's what this red area indicates here is your maximum loss. So this is the maximum loss that I could take, which, as you can see here, the stock went below that. So I did take a loss on this credit spread, which ended up being $3,254, just over that. And it was definitely not a small loss, so it definitely affects the track record. But the put here, of course, I made money on the put because I ended up having to buy the shares. That's the downside of the fact that I made this money. Yes, I made the money, but at the same time, I had to buy the shares at $230 when the stock was trading around $222. But I have a cost basis that's lower than the $230 because I have been selling puts on Amazon for quite a while, and my cost basis is well below the $230 that I paid for it. So just like any other weekly wheel, I will sell calls against the Amazon stock that I own. And then there's one more stock that I need to cover with you, and that is on AVGO or Broadcom. And this is where I sold a put ratio spread. So a put ratio spread is where I sell two puts that are out of the money, and then I buy a put that is further out of the money. And what this does, it gives me a situation where there's no risk to the upside, which is what this green arrow indicates, that no matter how high the stock goes, I am going to make money. If the stock trades sideways, I'm also going to make money. But if the stock goes down and pegs my short puts at expiration, then I can actually make quite a bit more money. So it gives me the opportunity to make money, to lock in a profit on the upside, to make money if it goes sideways, and then to make even more money if the stock goes down. Now, if the stock goes down too far, then yes, I will lose money. But look how far below the stock can go, below my short strikes, before I start losing money. It's a pretty good distance. So this is a very powerful strategy. It's one of my favorite strategies, and it's one that I'm going to be using a lot more in the future. All right, so now it's time to tally up my trades, see how I did overall for the week. We'll go through each one of them. Let me just explain to you the information I'll be sharing with you here. First is the symbol of the strategy, or the underlying for the strategy that I used. In this case, it's the SPY futures. The strategy that I used, this case was a strangle. The profit or loss, on this one I made $1,558. It was open for 23 days, which generated a profit of $67.74 per day. That gave me a return on capital of 10.5%, which is basically just how much of a return I generated on the capital that I had to tie up in order to implement the trade. And then if you take that return on capital and annualize that out for a full year, it would have been a return of 167%. Moving on through each transaction, the next was the Baidu covered call, where I made $69.49. Then the Google cash secured put, where I made just under $741 in 5 days. The weekly wheel in Google, where I made $322 in 3 days. The cash secured put in Palantir, where I made just under $3,265. The cash secured put in Palantir, where I made $4,920. The weekly wheel in Palantir, where I made $506. The weekly wheel in Palantir, where I made $738. The put ratio spread in Broadcom, where I made over $928. And the weekly wheel in Amazon, where I made just over $806. And then there's the loss, where I lost $3,255 in a put credit spread. And so let's go ahead and look at our totals for the week. My average annual return on capital worked out to be a negative number because the return on capital for that losing trade was such a big number. So it made my average annual return on capital a negative number. But my average return on capital was just over 2%. My average profit per day was $268.20. The average number of days that the trades were open were 14 days, and my total profit for the week was $10,600. So still, even with that large over $3,000 loss in Amazon, it turned out to be a good week. And let's see how it compares to the previous weeks. It is pretty close to being my top performing week for the year, losing out to week 5 by just over $100. So for the year, I am up $51,232, bringing my average to $6,404 for each week. All right, so that's it for this week's update. Thanks again for stopping by to check it out. If you have any questions or comments, please write them in the comment section below. I look forward to getting your feedback so that I can make the necessary adjustments on this channel to give you what it is that you're looking for. And as I said earlier, I'm looking to build a community of like-minded people. If you're an options trader, I'd certainly love to hear from you. What's your go-to option strategy? But anyway, that's all I have for you this week. Take care for now. Stay tuned because I look forward to bringing you more better options. Bye-bye.